Hello, everyone, and welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com, coming to you all this week from Dubai in the UAE. It has been a fantastic experience so far. We had the full day CMT 2024 summit yesterday. I got to hear from John Bollinger, and always a pleasure to hear from some of the mentors that I remember learning from just getting started in the industry, and hearing them reinforce some of the basic building blocks of technical analysis and why they're important. So helpful. We heard from money managers, market strategists, some very successful technical analysts sharing thoughts from all around the world. It's really been a global gathering here in a global city, Dubai, and it's been a fantastic experience. It's Thursday, February 29th, Leap Day, and let's talk about the market conditions here in our market recap. A nice rally going into the close for the S&P and the NASDAQ. The S&P 500 really getting a lion's share of its gains in the last 30 minutes, last hour of trading. The S&P finished higher, about 0.5%. So we're just below 5,100. We pulled just slightly below that level going into the close. But overall, pretty strong finish today for sure. Around 3 p.m. Eastern, it really wasn't that strong of a day, right? We sort of stalled out. But really the last hour showing some renewed interest on the buy side. The NASDAQ Composite, the NASDAQ 100, both up just under 1%. The NASDAQ Composite slightly below 16,100. Mid caps, small caps all up as well. Mid cap, the S&P 400 actually was the strongest of those three. And the VIX continues to pull back. So, again, in a slow and steady bull market phase, what we might think of as a healthy bull market phase, you have stocks rallying on low volatility. Look back to 2021 for a great example of what that kind of looks like. And we've seen that sort of return to that pattern, I think, here in our early 2024 and certainly periods in 2023. Looking at the interest rate and environment, pulling back a little bit here today. So you have the 10-year yield around 4.25, 5-year point right around the same level. The long bond yield slightly higher, around 4.38. The short-term end of the curve, of course, quite high, above 5%, around 5.25. So we still have that inverted yield curve as we have for so long. Some really great speakers. I really enjoyed hearing from Gina Martin-Adams, who's the chief equity strategist at Bloomberg Intelligence based in New York. I got to moderate a panel with her on Wednesday. And then yesterday, I was able to hear her latest thoughts on a panel as well. And again, what struck me about Gina's points, it was a lot less about what the market should do based on a perceived interest rate environment, right? Trying to, sort of set odds on different Fed rate policy paths and what that might mean for stocks. Her comment was focusing on the evidence of the market. And it was a perfect, set of points to make at a conference full of technical analysts. But it really struck home to me to focus on, whether we're in a recession, whether a recession is going to happen, whether it did happen. All of that is much less relevant compared to what the markets are telling you, because that's all about expectations. So let's continue to focus on price action in the market recap. Bond prices, of course, when rates are coming down, bond prices are going higher. So the TLT is just above 94. It's up about 0.7% from yesterday. And the dollar, again, not a big move of a week so far for the dollar, up about 0.25%, a little under that today. Commodities a little mixed. The DBC, which is a broad commodity ETF, slightly lower, down about 0.1% from yesterday. Gold and silver prices both higher, which I think is noteworthy. I noticed Newmont Mining as one of the biggest gainers in the S&P today. So the GLD, the SLV, both up. Silver prices up almost 1%. Crude oil prices slightly lower. Energy finished about in the middle of the pack in the 11 S&P sectors. Finally, in crypto land, all in the green, although cryptocurrencies choppy as always, and Bitcoin in particular was getting close to 64,000 over the last 24 hours, came off, almost got down to 60,000. Now we're kind of in the middle there, right around 61,500, and that's where we're at the moment after the U.S. market close. Ether prices just below 3,400. You can see the rest of the top 10 coins that we track on our platform, all in the green. Looking at the 11 S&P sectors here in our sector summary, you can see technology, communication services, number 1 and number 2. So for much of this week and really recent weeks, you've seen random defensive sectors at the top. Yesterday, I think it was real estate. The day before, I think it was utilities. So it really had sort of a weird feel to this market, some defensive sectors bubbling back to the top. Today was more of an offense and growthy offense at the top. So the technology sector up 1.1%, communication services up 0.9%. Real estate did manage to finish third, up 0.8%. 3 of the 11 S&P sectors finished in the red. Healthcare leading the way lower, down 0.8%. I just wrote an article for CNBC yesterday talking about the biotech sector, really potentially emerging from a broader basing pattern. The weekly chart of the IBB, I think, tells that story pretty well. But today, healthcare stocks pulling back slightly. Consumer staples and financials both slightly lower from the zero level from yesterday. I just want to jump over looking at what I call the Magnificent Seven and Friends. These are some of those leading mega cap growth names, which I think are such a big weight in the S&P. You really want to focus on the message. I read yesterday, I think these represent about 30% of the S&P at this point, which is pretty a staggeringly high percentage for a small group of stocks. But they are, again, represent a great deal of market cap. Amazon at the top of your list, up 2.1%, followed by NVIDIA, almost 2% higher. 2 of these were down, Apple and Tesla. And again, when you look at the Magnificent Seven in recent months, the 2 big outliers, certainly Tesla and Apple, while others were continuing to make new highs. I think NVIDIA and Meta are the ones that come to mind as good examples of that up and to the right, sort of consistent uptrend. You see Tesla and Apple, sort of diverging from the rest. They're down slightly today. Let's go to a daily chart of the S&P 500, see how things played out and what that meant for our daily price chart. As you'll see here, we remain above trendline support, and I feel like we keep. At some point, I may end up redrawing this line, but for now, I think it's a pretty good way to think about it because the October low to the January low, that's sort of that first setup. And I redrew this line after this point, right? I think when you break the line dramatically, you have to redraw it. That's not a question. But here we're more sort of, testing it, right? We break down, but we don't follow through, right? We close below the line, but then we sort of bounce right back above there. So again, with today's close, we close almost exactly at this green trend line that I've drawn. And all that means with prices remaining right around that trend line, with the RSI remaining between 50 and 80, kind of says we're in a nice consistent uptrend, kind of says that the momentum is strong but not excessive. And that kind of tells me we're in a pretty comfortable bull market phase here. Get nervous when that trend changes, when you get breakdowns of trendline support. When the RSI starts breaking below 50, that's when we can talk about a different feel to this market. But I don't see a change of character. I see a very consistent character, to be quite honest with you. Looking briefly at some of the breadth indicators that we want to that we like to highlight, I'm struck as I'm reviewing my morning coffee routine charts this morning, and as I've mentioned many times, I do go through the set of charts every morning just to check in. And I think one of the ways, if you want to know how you stay on top of the markets, and I often get questions about how I come up with charts for the show, how I sort of stay on top of things. It's a consistent routine every day. It's a consistent routine every week. I really try hard not to deviate from that. And over time, I've become more and more efficient at going through that list of charts, and it's not too bad. But this is one of the first charts that I look at after I look at the weekly and daily charts of the S&P. I start looking at market breadth conditions because I found a long time ago that was a great way of just understanding what was happening underneath the hood for these major averages. I can't help but notice that the NYSE's advanced decline line appears to be making a new 52-week high today. It's really, really close. It's sort of we're sort of right at the previous high, but certainly close to doing so. And one of the reasons why I feel confident that that's sort of on its way is because the large cap AD line and the mid cap AD line have both made a new 52-week high already this week. Now, the one that's really diverging here is the small cap AD line, which is well below its previous swing high. And again, we can debate whether or not small caps need to be a part of this bull market phase. It seems less and less that is a must-have, although I certainly was taught that, and I certainly remember thinking that way for quite some time. I think in this mega cap dominated market, participation in small caps is not as meaningful as it might have been, just given where assets are flowing, and they continue to flow to some of those largest names. AMD breaking out again today, among other mega cap leadership names. Also want to highlight the McClellan oscillator. Going to that chart here, did go right back above the zero line. So I feel like every time I bring up this chart, it's pretty much a guarantee that the next day or two will go back and forth. So I'm getting lazy not updating these colors just because it's too many things to try and update. But if you look, there are periods when the McClellan oscillator stays clearly above zero. There are times when it stays clearly below zero, and then this is neither of those times. This is when it's really, if there was a neutral setting to the McClellan oscillator, I would think of this as kind of that perfect time. We're spending a day or two above or below the zero level, but we're basically right around there. And what that tells me is basically there's no clear, momentum story using this particular breadth indicator. It's not a clear, it's a clear uptrend driven by stronger breadth. It's a clear downtrend driven by weaker breadth. This is sort of in the middle. It's a questionable trend in terms of the breadth conditions because they're really even, right? Basically it's telling you the trend in the advanced decline data is sort of neutral, right? It's sort of an RSI around 50, right? Mid-range. So no clear signal necessarily from there. I think you are getting some interesting signals from some other breadth indicators. I want to highlight the bullish percent index on the S&P 500 is very close to going back above 70. Now, as I've mentioned many times, I've highlighted in red when this indicator goes above 70. When it comes back below 70 has often been a very good sell signal for the S&P because it indicates that the breadth was excessively bullish and then was less so. And we highlighted that signal here in mid-January. We've been below that level for about 6 weeks now. The market has not even, blinked. It's continued to make higher highs and higher lows. Good reminder, I think, for me that regardless of what you see with the breadth indicator, price is most important. I don't think I've ever deviated from that. Price is king, right? If you want to focus on one set of data, focus on price. That is one of the many takeaways I have from this week at the CMT Dubai Summit in 2024. But again, reinitiating that buy signal, maybe this is a reset and we look for the next sell signal, which I will certainly be monitoring and highlighting for you. But for now, the market moving higher, even with breadth conditions that have turned slightly negative here recently. To finish off our market recap, our brief abbreviated show, and thanks for hanging with us this week as we try to do our show remotely from Dubai. The time difference is a beast. I'm 12 hours off of my home time zone. I've not really slept particularly well here, so I'm excited to get back home and get my body back in somewhat of a normal routine, but I wouldn't change this for anything. It's been a really cool experience. Let's look at a couple of these charts here. AMD making a new 52-week high today, up over 9%. So again, as much as we talk about the AI trade feeling overextended, as much as we talk about the euphoric conditions, I don't disagree with those assessments of price action up until today. AMD was a noteworthy chart because it had stalled out, right? When you think of an uptrend of higher highs and higher lows, a downtrend of lower lows and lower highs. You also have a third option, which is a sideways trend, right, where highs and lows are relatively even. And if you look, AMD's sideways, right, if you look from mid-January to here in late February, consistent highs, consistent lows, sort of a rectangle. That rectangle has now been broken with today's rally up almost or over 9%. I think something like this basically suggests that we had the rally, we had a consolidation, a pause button on that rally. The pause button has now been retouched, and it looks like we're breaking out to the upside. I always like to see if there's follow through. So I think Friday session to see if we remain above that breakout level, which is around 182, 183, we'll call it. I think would be important. But overall, I think AMD reinvigorating or reinitiating, confirming the strength of the AI trade as defined by some of these leading chip makers. If you had Hormel as the biggest gainer in the S&P on your on today's market bingo card, you won. But I think the odds of that happening were pretty low. But indeed, that's what life has given us today. Hormel Foods in an underperforming sector, consumer staples, and one of arguably the worst group within consumer staples, which is food products. This has been where some of the worst charts in the last 6 months have resided. You think about how the markets in terms of the S&P and the Nasdaq bottomed in October and then had a strong fourth quarter and then continued strength in January and February. Hormel is the exact opposite. It bounced off of the low in October for about 2 weeks and then just continued that downtrend that was happening going into that low, continued to be below 2 downward sloping moving averages. The relative strength obviously quite negative. Today, gapping higher on a strong earnings report. Today's close puts Hormel above the 200-day moving average for the first time since November 2022. Talk about a nice reversal. Now, anytime you have a gap name like this, it's very important, I think, to see what happens right after. So now we have revalued Hormel from around $31 a share to around $35. Do additional buyers come in and appear eager to own Hormel above the 200-day moving average? If so, this could be what's called an initiation gap or a breakaway gap that leads to further appreciation over time. If not, if you see sellers coming and we start to fill that gap, that tells you this was just an initial reaction to earnings, but overall the negativity that has fueled this longer downtrend still remains in place. So Hormel, an interesting chart, and again, your biggest gainer in the S&P 500 today. Norwegian Cruise Lines, ticker NCLH, on the leaderboard for the S&P as well, up over 3.5% today. A nice move higher. And I think when you think about the chart of Hormel, as I mentioned, the gap higher, and then wondering if additional buyers come in. Hormel is Norwegian Cruise Lines, NCLH, is a good example of that particular phenomenon. You gapped higher from around 16, opened around just below 18 a couple days ago, and then traded higher through the course of the day. That was Tuesday's session. Now, Wednesday and Thursday, you see additional moves to the upside. So this is showing you that additional buyers are coming in and seeing this as a good opportunity, even with the reset to the upside on that upside gap on Tuesday's session. I think that's a pretty bullish development here. You have overhead resistance here around $21 a share. That's the December swing high. But for now, it appears some short-term gains there in a cruise line group. Regeneron in the healthcare sector. Healthcare, one of the worst performers today. Actually, I think it was at the bottom of the leaderboard. The chart of Regeneron, which is in the biotech space, I think shows you, an example of what happens when a stock tests $1,000 a share. I often talk about big round numbers and why it's important to watch these. So I was not surprised to see Regeneron as it was approaching $1,000 a share as it became overbought on yesterday's session, thinking this is about the time when a name like this usually takes a bit of a break. Sure enough, we're down 2%. Now, I think this is a good reminder to take a step back, right? I was told, when in doubt, zoom out. So when you see an initial down move like this, really take a step back literally from your monitor, maybe zoom out to a weekly chart to remind yourself that this is overall a pretty constructive chart here. This is one down day, and I think we've got a lot of space to pull back a little bit and still be within a fairly constructive trend. You can go down about 8%, which would take us to the early February low. The 50-day moving average is around 930. You hold that level, and this is still a very constructive chart on that long-term and even the medium-term time frame. On the tactical side, this is telling you maybe we're in a bit of a pullback phase. Breaking above 1,000 would sort of negate that pullback and suggest further upside potential. Finally, Ulta Beauty, and again, classic technical premise of retesting a significant resistance level. One of the reasons why this show is called the final bar, as I've always told you, look at the final bar, the current price action, look to the left and see where we're at now versus where we've been. When you see a name like Ulta Beauty that has had an incredible run higher, but you're retesting a significant previous high, you always want to recognize that there's most likely going to be a pullback, right? It would be highly unusual that we would just blow right through an all-time high from a year and a half ago and not bat an eye, right? You usually would expect at least some sort of pullback off of that previous swing high. I think that pullback may have been started here. Again, the resistance is right around 560. That was the high. 550, 560 was the high we set back here in the second quarter of 2023. We're right there. So pretty normal behavior to expect a pullback. You get above those highs and break out. This could be a very constructive long-term chart, breaking out a significant resistance level. But for now, a bit of a pullback off of significant resistance. That's a wrap of this abbreviated show from Dubai here on Thursday, February 29th. Let's get to our 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. Here in our market recap episode, we talked about the S&P 500's bullish percent index. And again, I think one of the themes that we hit on in January was, sort of a seasonal play, right? Where you usually have market weakness in February and certainly into March. And maybe that the breadth indicators, which had been euphoric at the end of last year and the beginning of this year, maybe we're starting to indicate a pullback likely scenario for the S&P. Not to be, and even though breadth indicators have become less euphoric, the market has still moved higher. And again, it's a great reminder to me, when I think of priorities, it's price and then breadth and then sentiment. So as long as price remains strong, the uptrend is in play. Breadth conditions changing our speculation. That's thinking, all right, are we seeing some message underneath the hood of the top level indexes that may tell us a change is likely? I think we saw that signal in mid-January. It really didn't play out particularly as expected. The S&P has continued to move higher, and now the bullish percent index very close to getting back above 70. I'd be maybe looking for a move back above 70 on renewed strength, and then a break back below that 70 level could be that sell signal. Maybe we've just pushed this signal down the road a little bit, and maybe that would be the topping sign. But we'll continue to monitor the bullish percent index. Chart number 2, Regeneron, a great reminder that big round numbers like 1,000 are super important. You ask why this matters, and again, I think this goes back to market history. From the beginning, traders have paid attention to big round numbers because they're easy to focus in on. I think it's a great sort of psychological moment where people take a step back. And actually, there's been academic research that's been done that actually shows how orders tend to cluster around big round numbers, because that's where humans just kind of gravitate to those. And the meaning, whether or not it actually has meaning, probably not. But when something like Regeneron gets to a big round number, you often have a pullback. This is a great reminder that that particular philosophy is alive and well here in 2024. Finally, Super Microcomputer. This is our top ranked stock in our Stockcharts technical ranking, the large cap scooter rankings, as I mentioned. I just want to highlight, SMCI had this bearish engulfing pattern a couple weeks ago. For now, that was the top. Note that was right when the stock is testing $1,000 a share. So as I mentioned, I'm not making this up. Usually occurs. That's our high close for the cycle here, is almost exactly at 1,000. We pull back there. The next candle is what's called a dragonfly doji, maybe a hammer candle, depending on how you want to label it. I would label it as the former, and in either case, it's a short-term short-term bouncing signal. Now we're in this what's called a pennant pattern, which is lower highs and higher lows. This pattern usually resolves to the upside, and when it does, it usually suggests that the trend going into that pattern is probably going to repeat itself on the way out. So potentially a new buy signal coming as early as tomorrow for SMCI. This might be a really important chart to monitor to see if that's the case. Folks, that's a wrap for the show. Thanks for hanging with us this week as we record the show. Sort of an unusual time, early a.m. here in Dubai, evening back in the U.S. Wish you guys very, very well, and thanks again to all of you that I've met here in Dubai. Made so many great connections from technical analysis aficionados from around the world, and it's been a real pleasure. And I look forward to keeping in touch with many of you as time goes on, as we all head back to our homes and continue what we're doing. For Stockcharts in Redmond, Washington, this week in Dubai, I'm Dave Keller. Be well, stay safe. We'll talk to you again soon.